Hello, this is Boniface Chacha from Niafikra, and in this video we are going to look on how to deal with formulas. Formulas are an essential part in the configuration of elements of a payroll system, specifically this payroll system, where the deductions and incomes which we are going to use to associate with a certain employee with a certain contract, they will need a certain formula in order to calculate the exact amount which need to be deducted from their basic salary or to be added on top of their basic salary. And all these and other components, they are used to generate the actual pay, and which can be viewed on a pay slip of an employee. So in these videos, we are going to deal only with formulas, and this is because on the previous video, we look on the other aspect of payroll, and we skip the part where we deal with formulas. So in this video, I'll show you how to deal with formulas. So as we know, a payroll has two important elements, which are deductions and income, and these are in addition to the basic salary. So you'll have a basic salary, and then you can have other incomes on top of it, such as allowances and other deductions, such as pensions and insurance, which either need to be added or deducted. So the deductions are to be deducted and the incomes are to be added on top of your salary. Now, configuring these, you'll need to have a formula. I'll show you as an example. So, for example, you can have several deductions. So for example, this is a pension PPF, and as you can see, it is active, and there is a formula of 10% of the basic income for both the employee and employer contribution. Now we can create another one here. We can create another insurance, for example. So you can just create an insurance here and say this is health insurance, an HIF, and then make it active. And then you need to put a formula. So putting a formula, you can use this interface here. This is an interface for putting formula. So depending on whether you are doing an you're adding an income or a deduction, the fields which you are going to be to put the formula will be presented with something similar to this. Now remember, here we have two parts. The first part is for the employer contribution, so it needs a specific formula for employer contribution, and employee contribution also need a formula. So for our case, it is 10%, so you can just select here percentage. So this is how you put the formula, which is based on percentage. So you can just say it's percentage of basic income, and the percentage is 10. And the employer contribution, it can be the same, the percentage of basic income, and the percentage is 10. And when you save that form, you're done with configuring that insurance. But for example, let's say it is not in terms of percentage. Let's say it is an actual amount. So say in an HIF, you are doing an actual amount. So if you are doing an actual amount, then this part will become handy. Okay. If you are doing, if it is based on a table, this part will become handy. So for the case of for an HIF, which is insurance, it's percentage. Okay, so we'll save that. Now I'll show you another example which is based on a certain amount. So let's say we are configuring an income, and we are creating, say, transport allowance. So transport allowance, this is an allowance. So it's an allowance. Sorry, I keep confusing that. So can you say transport allowance, make it active. And so for example, you can see here also you're presented with a formula. So you can see this, it looks a bit different because when you're dealing with incomes, you don't need the employer-employee contribution, just need a formula for that income. And this is because most of the time deductions are the one which might have an employee contribution and employer contributions, but for income you don't actually have those situations. So for transport allowance, it can be a fixed amount, for example. So instead of percentage, now we can try to make it a fixed amount. So we can say it's a fixed amount of 25,000, and you can put the currency TZS and then save. So you can see now you have configured that allowance and you have put the formula, but the formula here, as you can see, is a fixed amount. That means no calculation is going to be done every time the payroll running and it need to know the transport allowance for an employee. It will just say 25,000. Now this is different from the deduction here, where when the payroll is run and it want to know the amount which is going to be deducted as an employee contribution, it will be the 10% of the basic income. So based on how much is a basic income for that employee or basic salary for that employee, this formula will take 10% of that, and that is what is going to be used in the payroll as a deduction for NHIF. I think that's a bit clear. Okay, so now we've looked on how we can configure using the money part, the percentage part, but sometimes a formula can be a table. So for example, when you're configuring tax most of the time is based on a table. So let's have a look here on a sample table for tax. Now this is a tax table for Tanzania. It was supposed to be in effect starting from 1st of July 2017, and this currently is 2019, and the same table is being used. So when these tables, sometimes they change, so you have to make sure that you are using the correct table. The table that we are using currently is the same table that we've been using since 2017, which is okay. So if they change, that means your table will also need to be changed. So for our case, we'll use this table here. Okay, now this table will need to be also configured in the system. To configure in the system is very easy. In the settings sections, there is a menu which says money table, so you can click that, and then here you'll be presented with option to create table. You can create as many tables as possible. It can happen sometimes, for example, the calculation of allowances for your employees, you also use table based on, like, say, basic income. So depending on how much your basic income is or the range of a basic income, we can determine the allowance to give you based on a table. But for this case, let's first look on how we use it for calculating of tax pay as you earn, and then we'll later try to see how we could use that for something else. Okay, so you can come here and say we need to create this table first before we configure the formula. So the table need to exist first before you configure any formula which is based on a table. So to do that, you make sure that you have access to your table, and then we can call this table pay as you earn table, and then we can add our entries. So you can see our first entry says from 0 to 170 there is no tax, so we can just say 0, 170, it is 0 shillings, nil. We don't charge anything, and even the excess factor is nil. Now you might be asking yourself, what does it mean by excess factor? As you can see here, for example, in the second entry, it says from 170 to 360, right? The tax amount is 9% of the excess of 170, right? But if you look on this, you'll see that from 360 to 540, first you have to pay 17,000 plus 20% of any excess on that. What does this mean? For example, here it means that if your salary is 400, that means it falls between this range here. Okay, if your salary is 400, first your tax is going to be 17,100 plus 20% of excess. So excess from the lower bound, which is 360 here. So as you can see, there is always a lower bound and a higher bound in this range. So the lower bound here is 0, the lower boundary here is 170, here is 360. So from 360 to 540, you have to pay 17,000 first plus 20% of excess of the lower bound. So that means if your salary is 400,000, you'll need, your tax will be 17%, 100 shillings plus 20% of 400 minus 360,000, which is like 40,000. So 20% of that, which is like 80,000. So you'll need to pay that. Right? You need to pay that as a tax in addition to 17,000. Right? Okay. Now, as I said before, you will need to configure this table into your system. So to configure that, you will need to put all this information. So for example, here the lower bound is 0, the higher bound is 170, and then there is no any amount which you need to pay. For example, like for this case, and there is no any percentage, so it's nil. That's why we said here the value, which is the basic amount that you have to pay as tax, is 0, and the excess factor is also 0. Okay, let's go to the second entry. The second entry is saying like from 170 to 360, you have to pay 9% of the excess amount. That means 0 plus 9% of 170. So here it will be from 170 to 360. You have to pay 0 and 9%. Okay. And then it says from 360 to 540, you have to pay 17,100 plus 20% of the excess. So it will be like 360, 540, 17,100, 20%. So this is how you do it. So as you can see here, all the information which is being said here is all here. Okay, and you will continue like that until you finish the whole table. Okay, so as you can see here, I've configured the entire table. Okay, and everything is ready. So for example, when we are configuring tax, so I'll just add another tax here. Let's just call this tax pay as you earn. Make it active. So we know it's based on a table, so we'll use this option, and we will say it's from the basic income, for example, and payee. This employee contribution, and then employer on this tax does not do anything, so we can just say 0. The contribution for the employer, it is 0. Okay, now you might notice that here, so what I said is when you're calculating for this tax, use this table, and it is based on the basic income. That will mean the basic salary of the employee is one which is going to be used to calculate here. So if you are paid, for example, it's 400, we will come and look here. Where does it follow on this table? So remember, this table is also configured into the system. So the system will do this specific calculation here, and it will determine how much tax you're supposed to pay. But as you may notice, this is actually incorrect, because the basic the pay as you earn is calculated based on what we call taxable pay, and within with a taxable pay is the basic income minus allowable deductions. Now, there are some deductions which are allowed to be deducted first before you calculate pay as you earn. Okay, so to do that, we will need to use another approach in order to come up with such formula, because with that formula it needs us first to deduct a certain amount before we use it for the pay as you earn. But for the purpose of understanding how to use a table, I think this example is okay, and we will come back to it after we covered that part. Okay, now let us look on something else to help us with correcting this mistake that we have done here. This mistake is purposely, and it's for the I want us to be able to grasp this concept. Okay, so the system comes with a functionality which we called saved formula. With this functionality, that means you can create your own formulas, okay, and reuse them when you're configuring either a deduction or an income. So for example, we have seen like most of the deductions here, they are based on 10%. That will mean every time you will need to come here, you have to create a formula which is saying 10% of the basic income. Okay, now we can actually resolve that. To resolve that, what you do is you can create a saved formula and say like call that formula 10%, for example. So I'll come to the menu here which says money formula. This is where you configure a saved formula, and when you click plus, you can give it a name. So say 10% basic income, and then I can say it's basic income 10%. Okay, so now as you can see, I've configured the same formula the same way that I've configured before, but I've saved it here. What does this mean? This means that I can go now to my either deduction or income and change or reuse that saved formula. So instead of configuring a formula like this, because when you're configuring here, we have to come here to 10 and then say it's basic income and then repeat every time saying it's 10%. What you can do is you can use that saved formula. So what you can do is you can say it's custom. To use the saved formula, you come here to custom, they create custom formula, and then ignore this but use saved, and then select your saved formula now here. Okay, so now you are using the saved formula here, and you can do the same even here. So just click custom, select here saved, and then say 10%, and then you can see we're using the saved formula there. Okay, now I know that I've viewed the custom here, and as you may see, there are a lot of things here that we haven't covered. I'll come back to them later, but for now, as you can see, you can actually create I want you to capture a concept that you can create a formula, save it, and then come and use it in your configurations here. Okay, so you can see here you're using the saved formula, but here you're not using a saved formula, but the result will be the same. So whether you are using you're creating your formula directly by saying it's percentage by using this option here, or you use a saved formula, the result is the same because the formula is still the same. You just the difference is with this option you are configuring that formula directly. With this option you are using the formula which has been saved. Okay, now good. Now that means we could actually come up with other formula. For example, one of the formula that we can come up is how to calculate the taxable pay. So we'll call it taxable pay. Okay. Now, a taxable pay we know is basic income, okay, minus, okay, so the taxable pay, when you're calculating taxable pay, we take the basic income of the employee, and then we minus pension. Okay. Now this is for the case of Tanzania, where we call any pension is we call it is one of the allowable allowable deductions, of which you can calculate them first before you minus tax from the basic income. Okay, so that means that basic income will be calculated on the remaining amount after you deduct pension. Okay, so now to do that, that will mean the formula will need to it will involve it will be a custom formula. Sorry, it will be a custom formula, and then to create that formula, you'll need to use this option here. Okay, now the way that the formulas have been designed in the system is it has been designed in such a way that you can actually create different complex formulas. Okay, and these formulas are all based on what we call basic functions. So it's the same as in arithmetic, where you can do multiplication, you can do subtraction, you can do addition, division, and everything. So this system also comes with those options. So for example, if you wanted to subtract, say, you wanted to subtract from the basic income, so I can just come here and say basic income. Okay, so then I can say minus. I want to minus deduction, which is pension. So I'll just come here and say minus PPF. Okay. So that will mean that this formula will involve subtraction of basic income minus PPF. But this is not the case. Most of the time you'll want to subtract all. Like it will depend on what kind of pension is that person is being paid. Okay, so that will mean we will have to deduct all of them. So it will be something like subtraction basic income PPF, sorry, deduction, then PPF, and then another deduction, so I can just say GPF. Okay, so what this formula means is it will take the basic income, then it will minus PPF, it will minus NSSF, and it will minus GPF. But you might find out, okay, this is not the case still, because most of the time when you're configuring an employee cannot have all those pension at the same time. Okay, so this formula actually is a bit confusing, but what you should know is the way payroll works is if a certain deduction is not there, is not in the employee contract, the amount that is going to be calculated is going to be 0. That means even if we use this formula, it will still work, because if an employee has PPF and doesn't have NSSF and GPF, that will mean the only deduction that will be affected is PPF, because all the rest of other pension will be 0. So the same way, if he has NSSF, that means PPF and GPF will be 0. Okay, but we can actually make it easier. So let's create another formula. Okay, before we create taxable pay, let's create another formula and call it pension. Okay, and in pension we can say like pension is actually all we want to have all pensions that could be in a certain employee salary. So the formula to use there is sum, because we want to add all of them. So we'll add all of them. So I'll say I want, because they are both deductions, so I'll just put them as deductions there, and then say the first deduction is NSSF, the second deduction is GPF, and this last deduction is PPF. Okay, so one thing you should notice, employee will most of the time have at least one of these. Okay, so since you'll have one of these, that means the rest will be zero. So calculation of pension for that employee will only involve the one that has effect on that salary of that employee. Okay, so as you can see here, now we have a formula for pension, and that's how it is calculated. But before we proceed, let me show you something. Let's create a sample formula. Let's just use this as a playground. Okay, I've mentioned that let's create a sample formula. I've mentioned that there are a lot of basic formulas here. Okay, so as you can see, you can do actually a lot of things here, right? So when you're creating your formula, if your formula is actually a fixed amount, as I showed before, it's not actually a formula, but you want, for example, if you know that your allowance is 10,000, and it doesn't matter as long as an employee has that deduction or has that income, it is 10,000, then you can use this basic function, which is money here. So when you select that, you can actually just write fixed amount here. Okay, and that will mean that that's the amount that is going to either be deducted. It depends where you're associating that formula with. Okay, so you can see here it's 10,000. Okay, but sometimes you might find like it's a sum, or if it's a subtraction. Okay, so with sum, this formula allows you, this basic function allows you to add different entries which you want to be added, to be summed. Okay, so an example, for example, it could be like you want to add, for example, your formula is based on summation of all allowances. So say like transport allowance plus communication allowance. So you can just come here and say sum, and then say I want to add all incomes. So select income here. I know it's two incomes, so I want to add two incomes, so I can just put them there and then say the first income is communication allowance, second income is transport allowance. So this formula now, what it will do is it will take the summation of these two. So as you can see here, so whatever amount that employees paid as communication allowance or transport allowance, it will be added here. Okay, but sometimes that means it can also be a subtraction. Okay, so maybe it's a subtraction of, as for our case, it's a subtraction of basic income. Okay, from the basic income I want to minus pension. Okay, so you can see now you can actually minus pension. So this is the formula that we'll use later as a taxable pay. But also you could be like minus pension, and then you could add other things like from that amount, whatever you get, minus a fixed amount, let's say minus 10,000 from that. Okay, so I'm just showing you like you could actually do a lot of things here. So you could just say it's a subtraction of whatever you want, it's an addition of whatever you want, depends on the need of your formulas. And this becomes handy because apart from those deductions and incomes which are mandatory by the government, which most of the times the formulas are either percentage or tables, you could want some of the custom, depending on your organization custom formulas. For example, the way that you're paying transport allowance or communication allowance is based on some complex formula within your organization. This system can actually accommodate that, and it can allow you, because uh, uh, presence of these basic functions allow you to become to create a very dynamic formula as you want. Okay, so it can be also a multiplication. So for multiplication, it will be like you're multiplying a certain let's say you are creating house allowance, and house allowance is twice your let's say your communication allowance. So you can just come here and say, I want to create I want to multiply my basic income. So multiplication of basic income times a certain number. So you can just say, I want to multiply communication allowance times 2. Okay, so in that formula is there. So this formula actually will take 2 times your communication allowance. Okay, but one thing you should notice is all these basic functions, they should result into money. So for example, here it can't be you can't say I'm multiplying communication allowance times transport allowance. The result won't be money, right? Okay, so for example, multiplication and division, they are actually money, anything which results to money, and then you can times it a number, or anything which result to money, divide by a number, depending on what you're doing. So for example, when you try to divide here, it will be, what are you trying to divide? So let's say it's basic income, whatever basic income of that person, times 2, divided by 2. So this could be your formula. So let's say probably this is how you calculate house allowance, basic income divided by 2. So if your salary is 400, this formula will say 200. Okay, if your salary is 800, this formula will say 400. Okay, yeah. So there are a lot of functions here. We've looked on how you can do money. As I showed you here, you are just putting a fixed amount of money. Okay, so this formula actually just return all the time this fixed amount of money. You can do sum. Okay, that means you can add whatever you want, right? So for example, if I want to add, let's say it's basic income, okay, plus with a certain income or deduction or income, so I can just say like that, and then I can say specify now what's the income. So actually this formula is basic income plus transport allowance. Okay, so as you can notice also here is when you're selecting a function here, like sum for example, or subtraction, when you click it, it gives you an interface for you to add your things. The same when you're multiplying, it gives you a different interface depending on what basic formula you're using. So for example, percentage, so you can just say here percentage. So percentage, it will be money times percentage, let's say, sorry, you can say like a certain income, 10%. But what is that income? 10% of an income. What is that income? You can come here and specify now that income. Okay, so as you can see, there is some sort of a tree structure here. So this is your formula. Your formula will be 10% of communication allowance. And just by like that, you can use those depending on what you want to do. If it's based on percentage, you'll use that. It is based on a table, just say table of, what's a table for? Let's say I want to look, instead we use the table for basic income. So here we can use the table for, let's say, communication allowance. Okay, so I can say this is my table that I want to use. Then, so as you can see, now I've created a table of communication allowance. So that will mean that on that table here, the amount that I'm going to use to compare the amount is that communication allowance. Okay, this is just trivial, we're just playing around, but it shows you like if you can actually create another table that you want, call it communication table, and create your formula based on that table to calculate your communication allowance. So instead of using percentage or fixed amount, you can actually also use a table. Okay, so you can see here there is gross income. Now these, we call them system formulas. You actually don't need to worry how to calculate this, because this formula, the system calculate. That's why you, when you select them, they're just there. The system actually know how to calculate the gross income, knows how to calculate basic income, or knows how to calculate other income. And by other income, what we mean is, in addition to the basic salary, you'll find sometimes you also need other incomes. So other incomes, any income apart from the basic salary is termed as other income. So this formula allows you to select what other income you want to include. So I could say include both. So that means this formula, if this is my formula, that will mean the amount that is going to be calculated here is actually summation of these two. Okay, so I could use sum to do this, but also this option here also helps you do the same thing. Okay, let's look another formula. Let's keep script for now. Deduction. So now this formula helps you to use the existing calculation. So for example, you've already configured your calculation for deduction for NHIF, and you want to use it somewhere else. So for example, we already configured NHIF, and we want to configure another deduction which is based on HIF. That this formula is what you can use for. Okay, so for example, if let's say, I can give you an example. Say you want to calculate communication allowance, and the communication allowance is 50% of your transport allowance. So you can say percentage, but percentage of what? Of another income. Okay, what is that income? I can just say communication allowance 10%. So as you can see now, your formula says 10% of communication allowance. Okay, so that is how you could use this deduction and income here. The existing calculations, you can reuse them somewhere else. Okay, so the same way, for example, if it's a deduction, I'll just say, for example, I want to multiply, I can say like the deduction for X deduction, any arbitrary deduction, is twice your health insurance, let's say NHIF. So I could just say multiply, then say deduction by 2, sorry, by number. So deduction, what is that deduction? NHIF, what is that number? 2. Okay. So this formula will actually take the amount that is calculated as an HIF, and it will times 2. Okay, good. So now the saved formula, this is the formula that I explained before. You can actually save formulas into the system, and you can reuse them here. Okay, so here you will see any formula that have been listed here. So if I say this will use the formula that is saved as 10% of basic income, or another formula that we saved as pension. Okay, okay, and you can see apart from they are also listed here, so you can just select them directly. You know, it's the same thing. You selecting them directly like that, you see your formula there, or you can just say saved and then select them like that. There's both options, they're giving you the same thing. Okay, it's just a saved form. Okay, now let's use the knowledge that we have discussed there. Okay, now before I go, let me show you. I think I skipped something there, and it's a script here. So another option that we'll see is a script. Now this system allows you to save scripts. Now if you don't understand what a script is like it's like a set of instructions which you can put using a certain computer programming language, and you can use in that script you can do complex calculations. Okay, so in this system we are using Groovy script. Okay, so if you don't know what a script is, probably this explanation is not for you. I'll create another video which will talk much about how you can use the script. For now, just ignore it, but you don't actually need it. Most of the time, the options that are presented here are enough. Okay. Yeah. Okay, good. Now, let's go back. As you remember, when we were creating this tax here, we said pay as you earn is actually calculated using not basic income, but what we call as taxable pay. And taxable pay is what you get from the basic income minus pension. Okay, so we already configured our table. So we say like let's create that that formula for coming up with the taxable pay. Okay, so the simplest way, this is the simplest way, and I'll go with this, is to first create saved formulas and then reuse them, and I like this option. So we'll create another formula here. We'll call it taxable pay, and then we'll create a formula for that. So to create a formula, you can just say subtraction basic income from the basic income we want to subtract pension. Okay, so now we have our taxable pay. So taxable pay is actually a formula which is calculated as basic income minus pension. Now remember, pension, we already say like pension is we sum all the pensions. Okay, so that will mean this formula will actually take basic income minus all these. Okay, now an employee might have only one of this, so that will mean the rest will be 0, and that's what we want. Okay, so now in our taxed formula we will change and reuse the taxable pay. So here, instead of saying like this, we'll say it's a table of taxable pay. Okay, so now our formula looks correct. Okay, and remember this taxable pay. What's a taxable pay? We already defined here what a taxable pay is. It's actually a subtraction of basic income minus pension. Okay. Okay, now this is the simplest way, and I like this. This works fine, but you can actually come up with it with your own complex way. For example, you could say, you could actually say payee. Instead of using saved formula, you could do something like this. You could say payee is, come up with a custom formula and say it's a table. Okay, a table of what? A table of a subtraction based on payee table. Okay, but what's a subtraction? It's a subtraction of basic income minus pension. Okay, so it's the same thing. Here I've configured that formula directly. The other way, I created the formula, I first created this formula, save it, and then reuse it. So it's the same thing. So as you can see here, it's a table of subtraction. So I'll take basic income minus pension and then calculate it based on the table which is called the payee table. These both options works, but I prefer the other one first. Okay, so I prefer the option where I just use the taxable pay because it allows me to change them direct here. Okay. Okay. Yeah, so that's it for formulas. Remember, formulas, with formula you can actually save them and reuse, as we have done here, right? Taxable pay is actually using pension. Pension is a sum. Also remember that when you are doing your calculation, if an entry is zero, for example, for this, if an entry is if an entry is not in the employee contract, it will be at zero. So this formula, which is calculating pension, although it is saying the sum of both of these, but only the one that is in the employee contract will be involved here. So the rest will be zero because that employee, for example, an employee only have PPF. So this formula will only sum that, will only involve that, and it will not involve this. We're using this trick because when you say pension, depending on which employee, the amount that will be put here, it will be different. So other employee might have GPF, other might have PPF, other might have NSSF. Okay, so depending on what pension you have, that's the amount that will be there. Another thing, okay, one last thing, there are some few things that I'll want us to consider. And the first one is when you are defining your formulas, make sure there is no cyclic dependency among the formula. So for example, when you're configuring a formula like this, okay, let's say it's you're creating a formula and you say okay, so you say like how should I put it? So say you're configuring income, okay, communication allowance here. Now, and you if you say communication allowance is actually a percentage of gross income, and then you say 10%. This is actually a cyclic dependence because when you're saying gross income, it also already include communication allowance. Okay, so that means for the system to come up with gross income, you have to first calculate the communication allowance. So you have to avoid those situations. Okay, they happen rarely, but you have to avoid those kind of things. And I think since an organization already has analyzed these formulas, those situations might not happen. But if you see a system telling you like there are the cyclic dependencies, because the formulas that you have configured is trying to use itself to come up with a value. Okay, so same way I shown you when you're saying communication allowance is 10% of gross allowance. Gross allowance actually need you, in order to come up with gross allowance, you have to come up to calculate communication allowance. But communication allowance depends on gross allowance, so it's a cyclic dependency. Okay, so that's it. If you have many questions, you can just post them and then we'll discuss.